During hyperinflation, all wealth stored or conveyed by currency can be wiped out. That's because hyperinflation occurs when the price of goods and services increase uncontrollably for a sustained period of time. Jack Dorsey, founder of Twitter and Square, says the sudden surge consumers have seen in food and gas prices could just be the beginning, tweeting on October 22nd that hyperinflation is going to change everything. Federal Reserve Chairman Jerome Powell continues to move the goalposts on inflation, from previously indicating that inflation would return to normal, 2% in 2022, to now saying that inflation could run well into next year. According to research from the Institute for Applied Economics Global Health, there have been 56 recorded cases of hyperinflation throughout world history. Could the signs we see around us today, supply bottlenecks, increasing prices, political instability, lead to our 21st century economy becoming the world's greatest hyperinflationary episode? Here's what to do when hyperinflation hits and how to protect yourself. We're going to go back in time to early 2014 in Venezuela. Venezuela is the best comparison to Western nations of today. Why? It was at one point a stable democracy and one of the most affluent economies in South America, thanks to its vast oil reserves. In fact, according to the World Atlas, Venezuela is home to the largest proven oil reserves in the world. However, in early 2014, Venezuela's plans for prosperity were rattled by an unexpected event that shook the economy. Beginning in 2014, the global oil price started to fall precipitously. In 2013, oil was selling for $100 a barrel. In 2014, oil was selling for $70 a barrel. By 2016, oil hit $33 a barrel. Because the price of oil dropped off so severely, Venezuela could no longer make as much selling their oil. To solve what appeared to be a temporary problem, the Venezuelan government, led by newly elected President Nicolas Maduro, printed more of the Venezuelan bolivar in order to be able to pay their bills. Now, printing money may seem silly, but it can keep the economy moving to get over a hump caused by an unexpected short-term shock that rattles a country. However, the Venezuelan government added so much money to circulation that citizens began to lose confidence that their money had absolutely no firm basis behind it to really give it value. They lost confidence that the money that they were holding would be able to retain any value that it currently had into the future as well. The situation in Venezuela was disastrous. The currency value dropped, pushing prices to rise, and the hyperinflation flame was lit. The result was a humanitarian crisis. Monthly salaries were not enough to buy sufficient basic goods. Nationwide energy blackouts began to occur, and citizens did not have enough money to buy the limited supply of food that was available in grocery stores. Illnesses became prevalent as a result of the squeeze on medical resources. Inflation rose quickly, culminating with a peak inflation rate of 65,400% 5 years after the original call made by President Maduro to print more bolivars. To truly put this in perspective, at a 2% inflation, which is what we can typically expect in the United States, your coffee, which costs $2, in the next year will cost about $2.04. At a 65,400% hyperinflation, the coffee in Venezuela, which used to cost $2, would now in the next year cost $1,300. It's not that your coffee has suddenly become worth over $1,300. It's that the fiat money you have in your bank account is truly not worth anything to you in purchasing power. As of September 2021, US inflation is running at a 13-year high of 5.4%. Right now, it's a fact we're seeing higher prices in homes, rents, gas, with the national average of $2.18 in October 2020 jumping to $3.30 in October 2021. Also up are meat, poultry, fish, and eggs. As we see in the case of Venezuela and other notable hyperinflationary cases, an unexpected event impacted a nation's ability to continue their economic stability. The government stepped in by printing more money in an effort to ease their citizens' pain caused from the unexpected event. But instead, this short-term happiness in receiving free money from the government and sparking the economy back on track created a currency hyperinflation fire. Does this sound familiar to you? So this leads us to, what can you do to save or protect yourself in the event of the incoming worst case scenario hyperinflation or a more realistic 5 to 10% transitory inflation over the next few years? As you now see from our study of hyperinflation in Venezuela, all wealth stored, saved in a bank, or conveyed by currency can be wiped out to being nearly worthless, and it affects everybody. There is no citizen left untouched. This would mean debts you would owe to others, your own savings, all would be completely worthless. There's no point in storing money and saving if the value of the currency is rapidly being eroded. Before we discuss the 3 golden rules in what to do in moderate 5 to 10% per year inflation that would be transitory, let's address the hyperinflation scenario. If hyperinflation were to hit, if the value of goods and services is rising hourly, daily, or even monthly in an extreme way, essentially everybody is screwed. The only way you could benefit from this scenario is if you were in debt when it starts. Your debts would essentially be wiped out. However, in the case of hyperinflation though, the best situation you can put yourself in is to own physical commodities. Grow your own food, own a farm. This way you can feed yourself and have something of value to others who will always need to eat to survive. You can own some gold or silver coins of value that you can trade for other assets, but own low denomination coins. It's unlikely you're going to be able to trade for food with a gold bar. Most other people around you won't be able to make change. The only asset that increases in value during hyperinflation is tangible assets. However, a hyperinflationary scenario would be a disaster for everyone and highly unlikely here in the Western world. However, if you see a period of transitory inflation on the horizon, there are a number of savvy rules you can follow to protect yourself or even come out in a better position than most everybody else in a period of transitory inflation. Here are 3. Rule number 1, invest in real estate. Real estate is a popular choice for 2 reasons. It's coincidentally Warren Buffett's preferred investment choice during periods of inflation. This is because the purchase is a one-time outlay for the investor and does not incur recurring costs. Furthermore, inflation increases the resale value of property over time, and inflation increases the amount that tenants can pay you in rent. This allows you to own an asset that keeps up with the rising prices caused by inflation instead of leaving you behind. Say you can't go out and purchase a rental house. Real estate investment includes this direct ownership like this or Airbnb type ventures. However, you can also look to leverage your money in the stock market by considering real estate stocks like real estate investment trusts, otherwise known as REITs. This is a much lower barrier of entry to get into, and you could buy into REITs with any stock market broker. Rule number 2, invest in commodities. Commodities are defined as raw materials or agricultural products that can be bought or sold. Researchers from the Mann Group and Duke University found that in historical times of inflationary periods, commodities have performed quite well. Gold has long been considered the go-to during inflationary times, and gold, as well as gold mining stocks, tend to perform well during market uncertainty, acting as a stabilizer. Other commodities tied to consumer needs like oil also tend to do very well. The cost of oil has influence with the rising costs throughout society, as oil is essential for society to function. Energy companies and utility stocks can do well also, as these are relatively fixed areas that society cannot cut back on and needs for function. For this reason, oil stocks and commodities have a strong appeal to investors when periods of inflation become present. Rule number 3, Invest in Series I bonds. Series I bonds are a special type of bond issued and backed by the United States government. Series I bonds are special because they offer two rates of return that are combined together. The fixed rate of return, which remains the same throughout the life of the I bond, and the variable inflation rate, which is calculated twice a year and is based on changes in the non-seasonally adjusted consumer price index for all customers. Essentially, Series I bonds are designed to keep up with inflation and can be a smart part of your portfolio in an inflationary environment. You can visit treasury.gov to learn more and purchase these bonds. It is no guarantee that hyperinflation, transitory inflation, or even no inflation happens. Economists argue around all sides of this. Inflation is typically the result of a mass loss of trust in the government and corruption, revealed in the idea that money the government is backing is worthless. What you can do, however, is be knowledgeable. It's always best to be knowledgeable and prepared for any event.